You're listening to the Decisive Podcast, insights and analysis to empower confident decision-making.
Good morning, good afternoon, and good evening, and welcome. My name is Jeannine Cataldi, and I'm an Associate Director with the Global Construction Team. And I'm joined today by the rest of the team, Sibiya, Amandeep, Bahra, and Shing Lee. And today we're going to go over the outlook for 2025 and some key themes within each region to look for in the coming year. So with that, let's jump right in. I'm going to kick us off here and do the high-level overview of our global construction outlook. So our forecast was released on January 7th and was driven by the global December macro outlook. And at the time, our macroeconomists were calling for global GDP growth of 2.7% in 2024, followed by 2.5% growth in 2025 and 2.6% growth in 2026. Now, when you compare this to our September outlook, the 2025 and 2026 growth rates are each lower by 0.2 percentage points compared to September's outlook. And part of the reason for this is really just reflecting the expected domestic and international implications of the assumed shifts in U.S. policy that are coming. At the time this was done, we had some ideas of what these shifts were going to look like or what some of these policies might look like, but we didn't know for certain. And I do want to caveat that, with the inauguration in the U.S. happening, there's been a flurry of activity, a flurry of executive actions, and we're still trying to kind of process what this might mean, particularly for the construction industry. So we are definitely keeping an eye on those moving forward. So with that, we did have this lowering of global growth, and how this factored into our construction forecast was basically, you see, we lowered growth in 2024 to 2%, and we lowered growth in 2025 to 2.5%. Some of the biggest drivers of this downward revision came from the Asia Pacific region, largely mainland China, which is the growth prospects going forward are much weaker than they had been previously. Eastern Europe and Latin America, and actually North America too, all three of these regions, a lot of these downgrades had to do with weaker than expected Q3 data that really pulled down the full year growth. And some of that did carry over, particularly Latin America, Eastern Europe, into 2025 as well. Each of the analysts will go through in more detail what led to these revisions, but we definitely want to address them because you can see that there has been this big downward shift. So looking at the kind of the more the near term, and really this is 2025, you can see that all regions, with the exception of North America, are going to see improved growth prospects in 2025 for construction spending. The North America region is kind of an outlier here. And this is largely due to just the outsized growth, particularly in the United States, that we've seen recently for manufacturing and infrastructure. This recent surge in growth is going to level off, and then that is really going to cause these growth rates to look like flat, declining, although spending levels do still remain elevated. So just keep that in mind. By segment, we can see, pretty similar pattern here. We're looking at 2025 for residential is going to gain some ground. A lot of this has to do with the majority of countries are seeing reductions in interest rates, lowering of these rates, which will help with housing, will help with getting people to purchase homes. So we do expect this residential market to pick up. Non-residential structures, after a surge in 2023, you can see that growth globally is kind of coming down. It's still growing, but a lot of these more muted growth rates are just coming off of recent surges and recent really healthy growth. And finally, the infrastructure segment, again, another one that has had recent strength, and we just see that moderating a little bit. This is still going to be the strongest segment of all the segments, and this just really has to do with a push by many governments to get infrastructure built, and it is a good way to kind of keep the industry moving forward. Looking at the individual segments, residential construction, once again, similar to total construction here, that North America is the one region that is down. All the other regions are expected to see strengthening in residential spending. And from that, so the North America region, again, there's been wild swings up and down. You can see from the growth rates 2023, 2024. 2025 is down. This has a lot to do with, again, in the United States, which is the largest feeder of this North America spending. We are seeing higher for longer interest rates. We are seeing affordability concerns. And moving forward, there is just some uncertainty that's going to dampen the market. But this is the one region that is going to see some pullback in residential in the coming year, whereas all the other regions are expected to see some growth. Looking at non-residential structures, we see, once again, North America outlier with declines this year. Manufacturing, which was your semiconductors, your EV battery facilities, there was a really big push in this segment that just, needs to taper off and come down. And as of a result of this spending leveling off and tapering off, you are going to see this weaker growth rate moving forward. All other markets with structures are seeing growth and stronger growth in the coming year. And infrastructure spending is one that we do see strength across the board. This is where all markets are doing well. And again, this is the area of construction that is going to lead construction spending for the near-term outlook. So with this quick, brief overview, I'm going to leave it to each of the analysts to go into much more detail and do the deeper dive. And so with that, I am going to pass it over to Neo Sibiya to talk about the Middle East and Africa construction outlook. Neo?
Thanks, Jeannine. I'm going to jump over to the themes for 2025. A theme that cuts across most regions, including the Middle East and Africa region, is global financial conditions being less accommodative than previously forecasted, stemming from expectations that the US interest rates will be higher for longer, inducing renewed concern about capital flight and currency weakness, resulting in an expected reduced scope for many central banks to loosen their monetary policies, with the speed and magnitude likely being slower than initially anticipated. We also see US policy shifts that may reflect a less favorable trade environment, which could potentially impact supply chains. And some of the themes that are specific to the Middle East and North Africa region are oil producers expecting to encounter increasingly challenging conditions that will impact both oil and non-oil economic activities. The anticipated decline in oil prices is likely to heighten the financial risks for oil-producing countries in the Middle East and North Africa region, leading to greater chance of delays or cancellations of significant infrastructure and construction projects. The second key theme for the Middle East and North Africa region is solid growth forecasted for GCC countries in 2025, largely driven by non-oil sector amid higher than expected interest rates. If we jump to Sub-Saharan Africa's key themes for 2025, these include structural changes in larger economies, which are forecasted to support growth in 2025. These include progress with infrastructure investments and increased private sector participation in transportation, energy, and water systems, which will bolster South Africa's economy. Additionally, governance and regulatory reforms should help to attract investment, such as that pledged by the EU, the UK, and the US, and broaden public-private partnerships. Still, under the structural changes, transitioning to market-driven values for the Nigerian naira could improve effectiveness of monetary policy, enabling the central bank to manage inflation with greater precision. Another key theme for the Sub-Saharan Africa is investments from the GCC countries, which are set to reach record levels in 2025, expanding new capital flows into Sub-Saharan Africa's economy. And then the last one that I'll touch on is lower consumer price inflation and monetary policy easing, being forecasted to continue supporting the household spending in 2025. Pass it over to my next colleague.
Thanks, Neil. And I'm going to jump over to the key themes. The growth outlook faced notable downside risks, much of the uncertainty around the global economic outlook stems from the magnitude and speed of expected policy shift by the new US administration on its trading partners. The faster implementation across the board could intensify trade tensions. And for Asia Pacific, higher tariff and trade barriers mean weaker exports, and increased uncertainty and retaliation might delay business investment and expansion. Asia Pacific is perceived as more susceptible to the economic performance of mainland China. The expected slowdown in Chinese growth is not solely attributed to the heightened trade war with the US. The country has faced insufficient domestic consumption following the property crisis and rising unemployment. So depending on the extent of their economic ties with mainland China, some may face bigger trade deficit, pressure on corporate profits, reduced domestic productions. Inflationary pressures from higher tariff will complicate the management of monetary policy for Asia Pacific central banks. The Federal Reserve signaled that it may only implement 2 quarter-point cuts in 2025, down from 4 as earlier indicated. So a scenario of fewer rate cuts in the US would mean slower in bringing down policy rates, given that uncomfortable interest differential with the US make currency and markets more vulnerable to shocks. So we expect policy rates to come down the most through the end of 2025 in New Zealand and the Philippines, and the least in Taiwan and Malaysia. At the same time, Japan is expected to continue raising rates. And last but not least, the growth outlook for 2025, the risk facing is politics. Most of the election across Asia Pacific held in 2024 resulted in leadership changes, incumbent party losses, or new coalition arrangements, including Japan and India. So major political reordering in 2025 remain most likely in Bangladesh, where the interim government installed in last year will almost certainly face domestic pressure in the form of large protests to hold election by early or mid this year. And in the Philippines, where midterm congressional elections will take place in May 2025, a diversified political campaign by opposing political groupings will increase the likelihood of a fragmented Congress. And in South Korea, the president's unexpected declaration of emergency martial law in early December have created volatility. But we expect the impact from political turmoil on the economy to be short-lived and relatively limited. But a possible delay in the budget approval process could compound sluggish consumer spending and weak business confidence, which are weighing on the domestic demand and economic growth. And that's all for Asia Pacific. I'll pass the floor to Amandeep.
Thanks. Turning to some of the key themes to watch in 2025, fiscal policy is expected to be tightened across most European countries. The re-implementation of EU fiscal rules that were suspended during the pandemic and high fiscal deficits in several member states will prompt European countries to tighten fiscal policy over the year. Governments are likely to rein in spending plans. However, the impact of fiscal consolidation measures will somewhat be offset by EU funds, which will remain which is another key theme to watch this year and also in 2026. EU member states are expected to ramp up the utilization of EU funds, especially from the Recovery and Resilience Facility ahead of its expiry at the end of 2026. So far, the European Commission has disbursed around 306 billion grants and loans to EU member states, just under half of the total funding envelope of 648 billion. This suggests we expect to see further disbursements as well as implementation of such funds over the next 2 years. However, as mentioned in previous forecasts, the risk of delays and absorption of these funds by the deadline, by the 2026 deadline, remains. Political uncertainty will remain across key economies, especially Germany and France. In Germany, we expect to see early elections in February. So uncertainty surrounding these elections will likely weigh on investor confidence in the near term, as well as policymaking decisions. Investor confidence will also take a further hit from higher US tariffs. It may also affect construction activity across the industry. However, it's worth pointing out that no major trade tariffs have been announced so far by President Trump in his first day's office. However, new tariffs are still being considered on European countries, and uncertainty around trade policy would like to keep investors on the sidelines in the short term. High tariffs would likely dampen economic growth in Europe and will consequently affect investment activity in non-residential structures in particular. Some industries such as construction equipment, electronics, and also chemicals would be exposed to higher tariffs and will lead to higher costs for producers. This may affect investment plans and projects in the near term, and that is something that we'll be monitoring for the next couple of months. Finally, monetary easing is expected to continue across Europe, however, at a varying pace in Western and Eastern Europe. Central banks are largely taking a cautious approach, especially in Eastern Europe, with fewer rate cuts or pauses in monetary policy cycles expected. This does suggest borrowing costs will still remain at a relatively high level for consumers and businesses in the near term, and it may consequently affect spending and investment plans in the near term. So that's it from Europe. I'll hand it over to Jeannine.
Thank you, Amandeep. I'm going to take a look at first Latin America. Some of the key themes that we are looking at for 2025, most markets in the region are expected to see more moderate growth. A lot of this has to do with potential impacts from US policy that are related to tariffs, which are going to affect trade, potentially pricing. Deportations from the US can also have an impact, as this can affect remittances going to these countries. And some of these markets, these remittances do account for quite a substantial portion of their GDP. So this is something that we're looking out for. With this, it could have the potential to lower some of this construction activity in the region. On the other side, you've got lower inflation. Many markets in this region are expected to see continued declines in inflation. You're also expected to see more easing of monetary policy, so your interest rates are going to gradually come down. Brazil is the one exception in this region. Brazil, as 2024 closed out, started raising their rates, their policy rates. So there's a little bit of tightening in that market. But the key themes I think to look for in this region in 2025 are really related to investment. We've seen a lot of announcements over the past year that are focused on hydrocarbons, renewable energy such as solar, hydrogen. But one of the biggest ones we're seeing is port infrastructure investments. With this, we are seeing investments across Brazil, Peru, Chile. We're also seeing investments in data centers, manufacturing, solar facilities, hydrogen facilities. This is an emerging growth area for this region, and we do expect that to continue going forward. Some of the things that we are still keeping an eye on for this region from the policies here, a lot of these markets have minimal room for expansionary fiscal policy, so we do expect there to be some limited growth in public investment, potential lowering of investment on the public side. And some of this also has to do with the fact that a lot of the markets in this region are expecting slower policy making, as many of the governments are being led without legislative majorities. So we do expect slower policy making. We expect these impacts, potential impacts from US policy to play a role going forward. Again, one of the offsets is that you do have quite a bit of already announced investment in a lot of these segments. Overall, you can see 2025, we expect quite substantial increases. Some of this is coming off of low base, particularly markets like Argentina, you can see. But overall, the region is set to have a good bounce back in growth in 2025 compared to the previous 2 years. Non-residential structures, again, is being strengthened by many of the projects that I just spoke about. Your data centers, your manufacturing, infrastructure is getting a boost from the port investments. There's also been investments announced in roads and airports. So this region is certainly set for some uptick in spending growth. And moving to North America, this is probably one of the largest impact region from the potential policy changes. So moving forward, some of the key themes we want to look at here, the potential regional implications of this policy. Higher tariffs will lead to higher costs, potential Increases on construction costs, tighter immigration policies can have a huge dampening effect on the construction workforce, particularly in the United States. This has the potential to lead to higher interest rates, less easing, increasing inflationary pressures across the market. This is something that we're keeping our eye on, especially as the flurry of announcements that has happened over the past day or so is come out, trying to kind of gauge what some of these impacts might be. Interest rate divergence. This region, we're seeing Canada is still expected to ease their policy rates in the first part of the year, but then kind of put things on pause later in the year as kind of effects or impacts of any policy changes come through. We expect that stable or tighter monetary policy in Mexico and the United States is going to happen over the coming year, again, due to these policy implications. Overall, the non-residential outlook, we've got a weaker outlook for infrastructure in Mexico. Still healthy in the U.S., but that may change based on some of these initiatives that have been put forth. Overall, when we look at segments in North America, residential is going to kind of level off. The United States saw a record level of housing completions in 2024. So we do expect some pullback there. There's also a weakness in multifamily in the United States. Again, there's some excess supply that has to catch up with demand. Residential is also going to be impacted by higher for longer interest rates. There's a lot of affordability concerns, particularly in the United States and in Canada as well. Those are going to factor in and kind of dampen residential in the coming year. Non-residential structures, we've seen, and you've heard me talk about it for a while now, the surge in manufacturing spending that we saw particularly for semiconductors and EV facilities in 2023. Growth continued in 2024, but we expect that to level off. And that leveling off is going to lead to decline. What comes out as declines in spending, and it's just coming off of a very high base. Infrastructure spending across the region, we do still expect an uptick in this. Mexico has a lot of infrastructure activity going on. Mexico also has port infrastructure, road infrastructure, airport infrastructure, battery plants. We're seeing a lot of stuff there. The United States, there is money that has already been dispersed for infrastructure projects. Going forward, maybe more into 2026, there might be a pullback depending on how these policies come forward. But overall, we do expect infrastructure to still be the leader in 2025. When you look at the different markets in North America, 2025, Mexico and Canada are going to see growth. The United States is down. Again, depending on how policies and things shape up forward, these could change. Right now there's higher level of downside risk for this region. Some of the things that we are watching after his inauguration, President Trump stated his intent to still do 25% tariffs on Canada and Mexico. That's going to have an impact on materials, manufacturing, housing. It's going to have an impact, a broad impact, if he goes through with those tariffs. We're also watching with immigration how this is going to affect the supply of labor in the United States. The construction workforce, it does have a large immigrant contingent, and if this weakens, there's already a shortage of labor in the construction area, and this could make things even tighter. This can push up wage pressures for the construction industry. So combined with higher input prices, higher labor prices for construction, you're going to see some inflationary pressures there. One thing that I also want to mention is that some of what President Trump put forth in the past day or so, there's some easing of regulations, which could potentially benefit the construction industry. But at the same time, there has also been a pause on funds coming out of the IIJA, the Bipartisan Infrastructure Law, as well as the Inflation Reduction Act. And between these two, there has been a pause put on funds that are flowing to electric vehicle projects, some manufacturing projects. There's been a pause put on offshore wind. The repercussions here are there's some manufacturers of parts for these offshore wind that are kind of putting activity on hold. Any buildings they were going to put up, facilities they would have placed on the coast of the U.S. We're also looking, because this shift away from clean energy, we're kind of keeping an eye on how that's going to impact that segment. There was recently, or again, I think yesterday, the announcement of investment, a massive investment in AI and data centers by the administration. The initial phase was a $100 billion investment. There is a data center that's under construction in Texas currently that is part of that initial $100 billion. We'll have to keep our eye on and just see how that's going to progress moving forward, how that investment will play out. Energy projects, there's a lot of energy needed for these data center projects. And right now, there's a lot of permitting and regulatory stuff that energy projects have to go through to be built. Prior to the administration coming in, there were already a flurry of announcements in terms of energy projects that are tied to data centers. And we will just have to wait and kind of see how this all shapes up moving forward. So overall, right now, we're kind of in a kind of a wait and see time frame, waiting to see what is going to come forth from the administration in terms of tariffs, the potential impacts on prices, what's coming forward with immigration, and some of these other initiatives and policies that are being put forth. We expect some of this to be much more clear in the next 3 to 6 months. Our U.S. macro team kind of expects that the larger impact is going to be in 2026. I will say, looking back historically at data, in 2017, which was the first year of President Trump's first term, we did see that construction activity, particularly non-residential activity, kind of took a pause. And then in 2018, it jumped back up. So we saw this kind of pause in that first year of the term to kind of get a feeling of what was coming, what was going to stick, and then things picked up. So I think we're going to kind of see something similar. We're going to see wait and see approach here in the United States and potentially in Canada and Mexico as well. So this region is really going to be one of the more impacted. Thank you all so much for joining us today. And as always, if you have questions, please reach. We wish you all the best for the rest of your day.
Thank you for listening to the Decisive Podcast from S&P Global. Please subscribe and join us for next week's episode. Until then, stay curious and stay informed.